Banking made simple. Explained in 5 minutes, let's face it, banking can sound complicated. Loans, interest rates, credit scores, reserves, investments. It's a lot, but in reality, banking is based on a few simple ideas that anyone can understand. In the next few minutes, we'll break down exactly how banks work, how they make money, and how they keep the economy moving, all in simple terms. Let's start from the beginning. A bank's main job is to connect people who have money with people who need money. When you deposit your money into a bank account, you're basically lending your money to the bank. In return, the bank promises to keep it safe and sometimes pays you a small amount of interest. But here's what most people don't realize. The bank doesn't keep all your money locked up. It keeps a small portion, maybe 5 to 10%, and lends the rest out to other people or businesses. This process is called fractional reserve banking. It allows banks to multiply the amount of money circulating in the economy. For example, if you deposit $100, the bank might lend out $90 to someone who wants to buy a car. That person pays the car dealer, who then deposits that money into their own bank, and that bank lends out most of it again. Step by step, your original deposit helps create more money in the system. Now, let's talk about how banks actually make money. The biggest source of income for most banks is the interest spread. That's the difference between the interest they pay you for your savings and the higher interest they charge borrowers on loans. For example, they might pay you 1% for your savings, but charge 8% for a loan. That difference, or spread, is their profit margin. Banks also earn money through fees. There are fees for maintaining accounts, using ATMs, transferring funds, missing payments, or using credit cards. Individually, these fees might seem small, but across millions of customers, they add up to billions of dollars every year. Another important part of banking is managing risk. Every time a bank lends money, it takes a risk that the borrower might not pay it back. To protect themselves, banks use data, credit scores, and strict rules to decide who gets loans. The better your financial history, the more likely you are to get approved and at a lower interest rate. But banks don't just make money. They also play a key role in the entire economy. By lending money, they allow people to buy homes, start businesses, and invest in growth. Without banks, most large-scale projects and purchases simply wouldn't be possible. In a way, banks are the bloodstream of the financial world. They keep money flowing where it's needed. Of course, banking today looks very different from what it did a few decades ago. Technology and artificial intelligence are changing everything. You can deposit checks from your phone, get instant loan decisions, and receive personalized advice from digital assistants. AI helps banks detect fraud, predict customer needs, and offer smarter financial products faster than ever before. But even with all this technology, the basic idea of banking remains the same: bringing together savers and borrowers, managing risk, and keeping money moving efficiently. Whether it's a massive international bank or a small community branch, the core functions are identical: to store, lend, and manage money. So, to recap, banks take deposits, lend most of that money out, and earn profits through interest and fees. They keep only a small fraction as reserves, rely on trust and regulation to operate safely, and use technology, especially AI, to make the system faster and smarter. And that's banking made simple. The next time you use your debit card or check your account balance, you'll know exactly what is happening behind the scenes and how every transaction plays a tiny part in the larger financial world.